So thanks for joining me today. We're going to talk about fundamentals of real estate investing. You guys saw that email that went out. And you're going to be talking with me, yours truly today. I'm your host, and I'm going to be talking about just the basic things about what you should be doing or what you should be thinking about when it comes to real estate investing, whether this is your first property or your fifth property or your 20th property. So just some really basic stuff, and especially in this economy that we're in, just some basic stuff that we want you to think about. So go ahead and advance to the next slide if you could. So next Thursday, our next webinar next Thursday, we're going to be having our RealWealth Investor Panel. And that is a panel that consists of a handful of members that are RealWealth members, and they have invested with us, and they're going to talk about their story, how they got started, what obstacles they had to go over, and all that good stuff. So we normally do that in a live study, which is great too, but we're going to have some of our members on to talk about their real world experiences. So stay tuned for that next Thursday. And we always have to read our disclaimer, so I'll go ahead and read this real quickly. The strategies mentioned in the presentation may not be appropriate for everyone. Other options not mentioned may be more suitable for your specific circumstances. Consult your personal accountant, tax advisor, and/or attorney to discuss your specific situation. Past performance is no guarantee of future results, and real estate purchases are subject to investment risks, including the possible loss of amounts invested. And while every effort is made to maintain accurate and current information, the possibility of errors and/or updates always exists. Okay, got that out of the way. All right. So real quick, a little bit about me. So I've been working with RealWealth since 2015, a long time. I've been in this industry for about 12 years, but I've been with this company for a very long time as well. So a lot of experience working with members. I also invest. I've been investing for 8 years. I currently own 8 rental properties, and I like to write music in my spare time. Just thought you guys would like to know something that's not work related or investment related about me. So before we kind of dive into the 7 fundamentals, I wanted to talk about the benefits of owning income property. Again, if you are new to investing, or if you're even seasoned investor, you might not necessarily know all the benefits of owning income property. Everyone just thinks owning income property is about cash flow. Well, there's other things, and so we can start at the top here. Another big one is the appreciation, right? Everyone knows that real estate does appreciate, it also goes down in value, but mostly over time it appreciates. That's one thing. The other one would be hedge against inflation. So what are we experiencing right now? Everyone who's attending, I'm sure you're realizing that everything right now in the United States is expensive, and we're having a lot of inflation. A lot, not as much as other countries, but we are still having high inflation. But investing in rental property does help hedge against that inflation so you don't lose money. Tax benefits. So there are numerous tax benefits, deductions, all that stuff that you get when you own income property. I mentioned cash flow, and then principal pay down. So those are just some of the 5 ways that real estate does pay you, or just some of the benefits of owning income property. So let's go ahead and I'm gonna go over a brief overview of, if you can go to the next slide, we're gonna go to the just a summary of what we're gonna do here today. So here are the 7 steps for every investor that we feel you should take and kind of prepare yourself when you're buying an income property. So step 1, clarify your goals. We're going to go over all these in depth. If you can keep going forward, we'll go through all these different ones here. So the first one, clarify your goals. The second one is going to be to define your current situation. Third is going to be to discover your purchasing power. 4 is going to be to determine your financial strategy. 5 will be determine your purchasing strategy. 6 will be determine your buy box. And 7 is going to be diligently execute. So we're going to go through all 7 of these real quickly here in the next 30 minutes. Oh, by the way, I forgot to mention as we get started, on the lower right-hand side of your screen, there is a box for questions. I think I can see those. So there's a chat box. So if you write a question in there, I should be able to answer some of those when we get to the end here. So just wanted to make that clear before we jump forward. So if there's a question that you have as I'm going forward in this, and you want to write it down, I'll try to answer as many questions as I can at the end here. All right, let's go to the step 1 here. So clarify your goals. So this is really, really important. Rich Fettke, the CEO of RealWealth, he does this investor webinar every year called the Focused Investor, and he just did it a few months ago. It's on our YouTube channel, and he does this every year, and even at the live events he would do this. And what's really cool about this is he would really he really allows people to imagine and really focus in on what you really want in life. And that's really what matters, is setting goals and getting what you really want in life. And so we start with this. And these are some of the questions that myself as an investment counselor or the investment counselors with the company, what we ask our members when we talk with them when we have a strategy session. So for example, why do you want to invest in real estate? Are you young and you're trying to take advantage of having lots of time? I've come into numerous members recently that they're young, maybe they're working part-time jobs, but they really want to get into real estate. They have a lot of time. They might not have a ton of capital, but they have a lot of time. And so maybe they want to utilize that time to get educated. Maybe you're close to retirement and you want to maximize your cash flow. Maybe you need more cash flow. Maybe you want to invest. Recently inherited some of money. Maybe your Aunt Helen left you $500,000 and you're just trying to decide on what to do with that. Maybe you already own some properties, some houses, and you want to diversify or even scale up to a bigger property. Maybe you want like a 10-unit apartment property, or maybe you want like a 50-unit apartment property. So we work with individuals that are in that situation. Maybe you want to become job optional. Job optional means that you have the option to quit your job if you want. Most people like what they do, but some people don't. And there are some people that I speak to that really say, hey, I want to quit my job in 5 to 10 years. And so that's a goal that we can talk about. Or maybe you want to reduce your tax liability. So again, maybe who wants to pay more taxes? I know I don't want to pay more taxes, but if you do want to reduce your tax liability and pay less taxes, we can talk about real estate investing, income property investing. So let's go to the next slide here, and we'll talk a little bit more in depth about your goals again. So having a clear goal in mind helps you turn those goals into reality. And you can train your brain. There's something called the reticular activating system, and I don't know all the ins and outs. All I know it's somewhere in the base of your spine, and it somehow allows you to think differently. And again, Rich I think goes over this quite a bit in his webinar. So, but yeah, definitely good to have a clear mind, because if you don't know, if you just say I want to own property, that's good, or if you want to own income property, that is a good start, but let's get more specific. Let's dive down and say, okay, well, why do you want to own investment property? So let's go to the next slide here. This is a great quote by Earl Nightingale. He said, people with goals succeed because they know where they are going. And that couldn't be farther from the truth. It really does make a huge difference by setting goals. Let's go ahead and advance to the next slide here. Officer, can you back up for just 1 second? I wanted to, before we leave the whole goal setting thing, one thing that I would really encourage you to do, and this is something that I learned, I believe Rich mentions it too on his webinar, but something that I started doing probably about 10 years ago is every year after New Year's, everyone has their New Year's resolutions. So what I do is I write down my goals and be very specific about them. And I know it sounds kind of silly to some people to say, well, I don't need to write my goals down. Well, writing them down actually makes a difference, because what happens is if you write them down, what you should do is every few weeks or every month, you should revisit those goals and look where you're at. Because if you just kind of write down your goals and throw them down or throw the piece of paper into your file cabinet and never look at it again, well, you're probably not going to achieve those goals. But if you actually look at them every so often, you'd be amazed that your mind really adapts and it starts thinking about that goal and how you can actually achieve it subconsciously. So let's go ahead and go to the next slide. We're going to talk about step number 2. So defining where you are. So how much capital do you have to invest? Let's be realistic about how much you have, how much you can save, and how much you can earn. So buying income property or rental property does take capital, whether it's your own or if it's someone else's capital. You need to have capital. And when we have strategy session, we talk about, and we're going to talk later in this presentation about different ways that you can get the capital besides just having cash in the bank. But let's figure out how much you have. If you don't have any capital right now, and that's completely fine, let's say you don't have any capital, how can you start saving? How much would you need to save up for your first property? How much can you save a month? How much can you save a year? Can you save up $1,000 a month? If you do that, within 2 years, you could probably have a down payment on a rental property. Let's talk about that. Let's go to the next slide here. So how much time do you have available to invest? So a lot of people don't have a lot of time. Maybe they work 60 hours a week or 80 hours a week, which sounds insane, but let's say you work 80 hours a week and you don't have time. Well, that's what's great about our company, is that we do have the ability to help you acquire property without having to do all the work yourself, because we've done a lot of the work for you. But yeah, I mean, do you have the time to save the money? But maybe you have the capital, but you just don't have the time. And again, that's where our network comes into place, because we have all these great connections, great markets, great teams, great property managers to help you with everything without you having to actually go to a class or study how to do real estate investing. So. And do you have any major life events on the horizon? Do you have a kid's college that is your kid going to college pretty soon, and you need to pay for that somehow? Are you going to change your career? Are you going to be taking care of your aging parents? Do you have a new baby on the way? These are, et cetera. Do you have health issues, that you have to overcome? These are things that you need to just basically realize where you're at and how you're going to pay for these things and how you're going to get there. And the majority of people want to buy income property because they want to pay for all these things. They want to pay for their kids' college, or they want to pay for or buy a house for their parents to live in, and they need that extra income. Okay, on to the next slide here. So step 3, discover your purchasing power. So this is a really cool segment that we're going to spend some time on, and this is going to talk about what you need to do to start investing and what you need to do to get to where you want to be. And again, we have people on this webinar here who are all over the place. You might be brand new to investing. You might have purchased a property a few years ago and you want to buy another property, but you haven't done it in a long time. You kind of want to understand what you need to do and how you need to get there. So this is a very powerful segment. So how much money do you need, and are you paying cash or financing? And those are the two big things. Are you going to get a loan, or are you going to pay cash? And we talk about reverse calculating your financial goals to conduct a reality check. It's kind of like one of those things where people say reverse engineer things. Well, we're going to kind of dive into that here in a second. So let's go ahead and go to the example here. Excuse me. So let's say that your goal, let's say this is Susan here, and Susan says, you know what, I want to get to $3,000 a month in passive income from income properties. Okay, to some people that might not sound like a lot, but to others it might. That might pay for your mortgage and your expenses for the month. And so that's a pretty reasonable goal. Another thing with going back to your goal setting, yeah, you don't want to set such a huge goal, in my opinion. This is my opinion, but saying that you want to earn $20,000 a month in cash flow is probably not the best goal right out of the gate. I mean, who wouldn't like to have that? But let's be more realistic. If you say I want to pay my expenses every month, and I just want to pay my mortgage or my apartment rent or my bills, let's start there. So how many houses would you need, and how much money would you need to have to do this? So let's go ahead and go to the next slide, and we're going to go over an example. So again, this is just an example. Again, this is going to vary on different things, but we're gonna give you the example of a home here for $130,000. Now, there are homes, believe it or not, if you're in a high-price market like California or the coastal areas or Washington or whatever, you might say, wow, a house for $130,000, that doesn't make any sense. How can I get that? Well, believe it or not, we still have markets that offer properties in this price range. They use a lot less, but given the circumstances of the real estate market across the U.S. and these different markets, the prices are a lot higher. But let's say you buy a house for $130,000. The down payment is going to require you to put down $26,000. That's 20% down. You can do 15% down, but then you have what's called mortgage insurance, and that does cost extra money, and then you have the prepay penalty, and don't really recommend doing that, but you can do 15%. Most of the members I talk to are just doing it to 20%, so you don't have mortgage insurance. Your closing costs are going to be estimated at $5,000. Again, that's an estimate. It could be a little higher. It could be $6,000, it could be $7,000, it could be even less, but let's just say $5,000. Your cash reserve. So we say that for every property you buy, you should have about $5,000 in reserve, and that's going to help with any kind of vacancy or maintenance issues that you have in the property. That's per property. So what does that equate to? Well, that's going to equate to about $36,000 that you would need to buy this property. Now, think about this. This is pretty amazing. You're buying a house for $130,000 and you only need to put down $36,000. As compared to like the stock market, if you wanted to buy stocks, if you wanted to buy $130,000 worth of stocks, you typically have to put down $130,000. So we're leveraging in this case, which is amazing. So $36,000 per door. Let's go to the next slide here. We'll go drill down a little bit more. So let's say that house is renting for $1,100 a month. Again, it could be a little higher, could be a little bit lower, but this is a good ballpark rent here. Your expenses on the property, including your mortgage payment, your taxes, your insurance, your property management fee, would roughly be about $800 a month. So that's going to net you about $300 monthly cash flow net. Okay, that's after everything. Not too bad, right? Not too bad. Go ahead and go to the next slide here. We're going to go down, drill down even further here. So again, cash flow $300 a month. It might be less, it might be more, depending on what you buy. But these are just examples here. Now we're going to give the examples if you were to buy 10 houses, 10 single-family homes. Now this doesn't mean that you're going to buy all 10 houses at once. Okay, rarely do we have people that do that, and I really wouldn't even recommend doing that, just because it's a lot to do at once, and you might not know. It might be too fast for you, so I don't recommend doing that. And you probably couldn't even do it anyway in this market because there's not that much inventory to buy, to be honest with you, at one time. But let's just say 10 houses total, okay? So if you have $300 a month, which is $3,000 a year in cash flow, you would need 10 houses to get to your $3,000 a month in net cash flow, if that makes sense. So 10 houses, each house is spitting off about $300 a month in cash flow. That's going to give you about $3,000 in cash flow. And what that equates to is about $36,000 a year. And what that would require capital-wise would be $360,000. And I know everyone's like, wow, how do I come up with $360,000? That's a lot of money. I completely understand. Again, we're not saying that you buy all these houses at one time. A lot of members I talk to, one of the strategies that I recommend is if you can't save up a lot of capital, or you don't have a lot to begin with, maybe you can save up capital every 1 or 2 years, and you can buy property every 1 or 2 years. So again, this does not mean that you have to buy them all at once. But yes, you would need this type of capital to buy 10 houses to get that. And it comes about, if anyone's wondering what that return would be, I can't give you exact cash on cash returns, but it's about 10% cash on cash return, or just slightly over that. So let's go to the next slide. We're going to talk about all cash. And this is for somebody who has cash in the bank. They don't want to finance, they don't want loan. Maybe you're close to retirement and you have a bunch of money that you sold from the stock market, or maybe you sold a house recently and you don't want a mortgage. So same example, $130,000 house. Closing costs are going to be less because you don't have your financing costs in there. Financing costs are quite high. So you're only looking at about $2,500 for your closing costs. Cash reserves is about the same, and you're looking at about $137,500 all in for cash if you were paid cash. Now, what would that look like? Go to the next slide here. What would that look like if you were to, we still have the rent here. Yeah, so the rent's the same. Let's just say $1,100 a month. Now your expenses are less, and that's because you don't have your mortgage, your insurance, your taxes. You still have your property management and you have your insurance, but you have your taxes, your insurance, and your property management, but no mortgage. Okay, so that comes out to about, on that property, if we're renting for $1,100, that comes out to about $800 a month in cash flow. Again, it could be a little less depending on where you're at. You know, some parts of the country have higher tax rates than others. Some have lower tax rates, and some have higher rents, some have lower rents. So it just depends. But let's just say it's $800. That would be your monthly cash flow. So let's see what that would look like on the next slide here. How many houses you would need to get if this was the same outcome. So if you wanted $3,000 a month in net cash flow, you would need 4 houses. So again, $800 a month times 4 is roughly 4 houses. I'm sorry, $800 a month times 4 houses is just slightly over $3,000 a month in cash flow. We were going to put 3.75 houses, but that's kind of odd. So we left it at 4 houses. So that's how many houses you would need to buy, and how much capital would you need would be $550,000. So again, 4 houses times $137,500. Each house is $550,000. So you see, you will need a lot more capital. One thing I want to point out before we move on here is that the power of leverage. So if you remember in the financing scenario that I gave you, there were 10 houses there, right? So that means that your net worth is a lot higher. And net worth meaning the total combined asset value of your portfolio. So if you had 10 houses at $130,000, that's $1.3 million in assets that you own, right? That's pretty huge. So if you pay them off at some point and you didn't have any loan on all 10 of those houses, you would be a millionaire. You'd have over $1 million in assets. Pretty awesome. If you pay cash, you'd only have $550,000 worth of net worth, right? So a big difference, right? Yes, you're getting less houses and you're getting more cash flow, so to speak, sometimes with cash, but you're not getting your net worth. Your net worth is not as high. So just wanted to point that out. So yeah, so again, just to sum it up, those are just examples, and we're going to talk a little bit more in depth about your unique strategy. And when we have these strategy session phone calls with you guys, we really we dive into this and talk specifically about your scenario and what is going to be best for your scenario. All right, let's go ahead and advance to the next slide here. So here's some takeaways. So be realistic about how much capital you need to hit your cash flow goal. Again, if you say I have $0, but I want to hit 10,000 a month in cash flow, how are we going to get there? Well, we have to be more realistic and say, okay, how much can you save up? Because that's what you're going to need to do. More capital can generate the same amount of cash flow with fewer doors. So yes, you need to buy less homes, which means less loans, but that also means you need more capital. Homes purchased with cash reduces my cash on cash returns. So again, and that's why, and that's what I was pointing out earlier, is that you're not leveraging. So interest rates right now are extremely low right now. I mean, I've had people buying investment properties. I haven't bought a property for about a year myself personally, but interest rates right now on income properties are like in the high 3s, low 4s. It's pretty phenomenal. Most of my properties I've bought over the years are like in the high 4s, low 5s. So take advantage of leverage. But anyway, the cash on cash return does go up when you leverage because you're using less of your money and more of the bank's money. And then remember to consider all 5 ways that real estate pays you. So it's not all about the cash though. There are other benefits. Again, the tax advantages, the appreciation, the depreciation, and the leverage. So I hope that makes sense for that step there. So we'll go ahead and continue on to the next one here. Okay, so step 4, so determine your financing strategy. So this is another really big topic that we like to dive into with our members when we're having strategy sessions. We talked about this in the scenarios in the last step. So you can either pay out cash or you can use financing. Now, financing does require you to qualify for a loan. And can you qualify for a loan? If you're not working right now and you're not employed, then you're not going to be able to get a loan. I hate to say it, but you're not going to be able to get a loan. Even if you, now if you have experience, let's just say you've been an investor for 20 years, you might be able to get a loan. There are some investors that do an asset-based loan, but most likely with the Fannie and Freddie loan, you're not going to be able to qualify with that. Now, we do have lenders on our website, and I'll talk about that at the end of our call where you can find all that information, but we do have professional lenders that we work with and that we can put you in touch with to go over all that situation. So, but yeah, you're either going to pay cash or you're going to use financing. Go and advance to the next slide here. We'll continue. So you can use equity from another property. So, and we talked about 1031 exchange. So I'm not going to get in depth on what a 1031 exchange is, but if you don't know, it's basically if you own a rental property, you cannot do this on your primary home. But if you own a rental property, whether it's a single family home, multifamily, office space, industrial, you can actually sell that and exchange the equity that you have out of there into something new and defer the taxes. So, for example, we have a lot of California investors that are taking advantage of this now because your home has gone up a lot in California, or everywhere really, but in the coastal areas, a lot of homes have gone up quite a bit. So maybe you have $400,000, $500,000 in equity, and you're only getting $1,000 or maybe $2,000 a month in cash flow. Well, you can utilize that and leverage that property, possibly sell it if it makes sense, buy 7 or 8 or 10 or more houses or multifamily properties and hopefully double your cash flow. You can also get what's called a home equity line of credit, and this could be on your primary home. So they're on your primary home. Let's say you have a really low interest rate and you don't want to touch the interest rate, because I wouldn't recommend that. If you have a 2.5% or maybe even a 3% interest rate, I wouldn't touch that because that's where rates are at right now. There would be no sense to do a cash out refinance, which is the next bullet point here. But if you don't want to touch that, you can do a home equity line of credit on your primary home, and that means basically they give you a line of credit for $80,000, $100,000, whatever you qualify for, and you can take out as much as you want or as little as you want and borrow that to finance or pay cash for new rental properties. And then typically you pay off the HELOC next time you refinance your home. You pay off the HELOC and you roll all that HELOC right back into your home. I mentioned cash out refinance. Oh, by the way, you can't do, I shouldn't say can't, but there's not really any banks that I know of that can do a HELOC on an investment property. There used to be, and if anyone knows any, I'd be more than happy to hear about it, but those are really hard to find, any kind of bank that can do a HELOC on an investment property. The last one here is cash out refinance. So again, this would be a situation where if you didn't have a low interest rate necessarily, maybe on your primary home or rental property, and you wanted to tap into the equity again, you can pull money out and again either leverage that and buy more property or pay cash. So again, these are just some of the ways that you can actually use equity. So if you own homes right now, definitely think about that. And then the last one here is use your retirement account. We don't talk too much about this in our network, but we've done several webinars on it in the past. And you can use your IRA or your 401k to buy real estate. Now, I don't know if you know this, but you can actually buy a rental property cash in your retirement account, or you can actually finance. The banks do require you to put about 40% down or maybe even 50% down if you're doing that in your IRA. But guess what? You don't have to qualify for that individually. So if you don't have good credit or you can't qualify, maybe you lost your job, or maybe you don't have, maybe you're working part-time, you can't qualify for a regular conventional loan, you can use your retirement account and do that. So again, talk with us about how that would work. And another thing I didn't put on here, but you can actually borrow against your 401k. If you have a 401k, check with your custodian, but you can actually borrow and take a loan out against that. And the great thing about that is you can actually pay yourself back. So you're loaning yourself money and you're paying yourself back. That's pretty phenomenal. But all the money stays in your retirement account, so it doesn't go in your personal account. So again, these are some creative ways that we talk about on a strategy session with everyone here on just how to get the funds. Step 5, same thing here. So we're going to talk about how quickly can you save up enough for homes. We just talked about that earlier. So again, my recommendation would be to go with you're comfortable with. I know a lot of these gurus like Susie Orman and who's the other guy out there? I can't think of his name. A lot of other guys out there who are talked about loans and credits and stuff like that. They talk about saving money for down payment, and you need to save. It's important to save for something that you really want, and you're saving for an income property. And I tell you, once you buy your first property and you start buying your second one, your third one, it only gets easier because I don't know how hungry you are, but if you're extremely hungry and you want to buy a rental property, you will cut back on things. You'll cut back on your $5 lattes at Starbucks, or maybe now they're $7. I have no idea how much they are. But all these things that you can start saving money on, you'd be surprised. And there's actually apps out there that allow you to keep track of your spending habits and stuff. So can your debt to income ratio support multiple acquisitions? So I'm not going to go too much in depth on this, but this is what the lender looks at when you're qualifying for a loan, your debt to income ratio. And lenders, the maximum that they allow you to have if you're going to get a conventional loan is 50%. It's usually between 48 and 50%. So if you're already there, then most likely you're going to have a challenge getting a loan. But if you're not there, and again, you can check with one of our lenders and they can tell you what your DTI would be. Because if you want to acquire 2 or 3 houses or 4 houses in a year's time, we want to make sure that you have a good low DTI there. So always remember that more money equals less time, and less money equals more time. So again, kind of going back to, if you have more money, you generally don't have as much time, and if you have little money, you generally have more time. And so it's always good, if you don't have enough capital, it's always good to find somebody who has capital, a family member or maybe a good friend that you want to partner up with, and maybe they're busy, but maybe they have capital. Maybe you can help them and you guys can set up a partnership that way. So property types. So this is going to be something to also think about, and this is what we talk about on our strategy sessions in depth. What are you looking for? I mean, maybe you don't know what you're looking for, but are you looking for a single family home or a multifamily? And when I'm talking about multifamily, I'm usually talking about 2 to 4 units. We do have a few markets that offer larger apartment properties, but I don't recommend anyone step that far into that realm unless you are an advanced investor. But single family versus multifamily, what is better? They both have their pros and cons, and so we would definitely talk about that. A class, B class, C class. These are just the different areas where the property is at, and this goes in line with the last bullet point there: risk versus reward. So a C class area is generally a lower price point property, but the risk is that you do run the risk of having a tenant issues, because the tenant quality is not as good in those types of areas as compared to a B or A class. If you don't want that and you're more risk adverse, you don't want to take that risk of an eviction or things like that, stick with a B or A class neighborhood. Most of our markets have a mix of C, B, and A class, and so you can kind of pick and choose. And again, we can talk about on a call. We could talk about which just by eyeing a property, I can usually tell, and we'll teach you how you can actually learn to look at neighborhoods based on what the price is and what the rental price is. You can kind of tell a lot by that. All right, so market diversification. If you guys have mutual funds, if you look at that, if you do look at your statement every month, some people don't, surprisingly, but if you look at that, is, you know, your money that you're putting into your retirement account is diversified into different things, you know, stocks, bonds, treasury notes, whatever it might be. And so we say the same thing for investing. So when you do grow your portfolio, we want you to diversify. And that's the great thing about our company and our network, is that we have all these different areas, and you can see in the map behind there all these different red dots where we offer property, and it's all over the place. You know, for example, you might want to buy something in the Dallas area that might yield higher appreciation, because there's a lot of job growth there, and the appreciation potential is probably a lot higher there compared to somewhere in Cleveland, Ohio, or Cincinnati, Ohio. So, you know, do you want to have 4 homes in one market? You can certainly do that. We don't have anything, and there's nothing to say that you can't buy all your homes in one market, but diversify. Maybe you want to buy 2 homes in 2 different markets, or maybe you want to buy 4 homes in 4 different markets. I personally own in 4 different markets, and I have a couple properties in each one of these markets, and I think it's completely fine. And why I do that, and why we recommend doing that, is because let's say something drastically happens in that market. Let's say the jobs shift and something happens and a lot of jobs leave that market. Well, you don't want all your eggs in one basket, right? Same thing with your mutual fund. You don't want to buy all your stocks all your money in one stock, because you could lose a lot of money that way. So same thing here. So again, that's really important, and we recommend that you diversify your portfolio. So here's our example again. So if you have $130,000 to invest today, let's say you have that, or it could be 100,000, or it could be 80,000, whatever. Let's say you have that. You could buy 1 property with cash, or you could buy 4 properties with 20% down in each one. What would you rather do? I mean, again, it depends on your scenario. As we talked about earlier, if you're near retirement and you don't want to have a mortgage, you want to enjoy the more cash flow and benefits now, maybe you pay cash. If you're young and you're working and you plan on working for the next 20 years, I would recommend you finance and take advantage of the lower interest rates. You would need approximately $20,000 in a reserve fund if you were to buy 4 at once. Okay, this is just, again, if you were to buy 4 at once with $5,000 for each property. And again, the $5,000 reserve fund is for maintenance and vacancy loss. Now, as you grow your portfolio and you start saving up more cash flow, you know, you're not going to necessarily need to take out more and more money for reserves out of your own pocket, because you're going to have more money set aside from your cash flow. But yeah, so again, just recommendations and everyone's going to have a different scenario. So this will be scenario A. So this is a really interesting thing to talk about here. So and I know a lot of companies go through this, and I'm not going to go through all the text. Well, I'll go through this real quickly, I guess. But basically, the snowball effect. It means that this scenario here, you buy 4 homes, and again, it could be 1 home per year. So let's say in 4 years you have 4 homes and you're generating $300 a month in cash flow. So if you took that $1,200, which is $300 a month per times 4 properties, and you took that $1,200 and you paid it towards a principal each month. So you took that and you threw the money and you didn't use it for down payment on another property, then that first home would be paid off in about 9 years. Pretty amazing, right? You still get a 30-year fixed loan, but you're able to pay it off in about 9 years. So again, we know you're going to have maintenance issues, and we know you're going to have things that are going to come up. But this is a pretty awesome way to look at this, that you could pay the first house off in 9 years. Then you continue using the cash flow again, and you have the income from your other property, because now your property goes from about $300 a month to about $800 a month, right? Then you're getting, you know, maybe you're getting about $1,600 or $1,800 a month, and you're throwing all that cash flow towards the second property, and your second property would be paid down in about 7 years. And then the third property would be paid off in about 5 years, and then the final property would be in about 3 years. So in less than 25 years, you'd have all 4 properties paid off. Now, I know what a lot of you are thinking. You're thinking, well, if that's only 4 properties, that doesn't seem like a lot. But imagine this, in 25 years, your rent is going to go up. We know that rents go up. Even in 2009, when the financial crisis happened, rents went up. And look what they're doing right now. Rents are going up 4%, 5%, 6% in a lot of markets right now. So in 25 years, imagine what your rent, your $1,000 or your $1,100 a month rent will be in 25 years. It might be $1,800 at that point. So we say you're going to be cash flowing $32 a month, and that again, that's just a rough estimate, but it could be a lot higher than that. I know taxes are going to be higher and everything too, but your rents are going to be higher. Excuse me. So pretty cool. This is a really cool scenario, and you only need 4 houses. So imagine if you only bought 4 properties in 25 years, you paid them off, and you had $5,000-6,000 or more a month. I mean, it doesn't take a lot of properties, you can see, to do this. Let's go to scenario B. Scenario B would be if you bought 4 homes and you just let the cash flow build to buy additional homes. And this is kind of what I'm doing personally. I'm in what's called an acquisition mode. I'm just acquiring properties. I mean, I'm 42. I plan on working for a while. I love working. I know it sounds weird, but I do really like working. I enjoy it. I love working and educating people on what I do. So I plan on working for a while. So I'm taking all the cash that I'm from my properties and I'm putting it down on another property every couple of years. So this is an ideal plan for someone who has 20 to 30 years left before retirement, and maybe they don't have enough cash flow right now to buy houses, So you get started with one property, you start saving the cash flow up. Maybe 2 or 3 years later, you could put a good chunk of money down on another property. Once you get to about property 5 or 6, then you're usually able to start saving almost a full down payment for a property, depending on the price points, of course. But that's pretty phenomenal, because then at that point, you're just using cash flow from properties for down payment, and it just gets easier and easier. So the goal in this case is to acquire as much property as possible to maximize the benefits of owning income property and leverage the value of time. So again, this might be a slower route to go, but again, if you're 25 or 35, or even if you're 40 and you're not going to retire for maybe another 20 years, this is a great plan. And it's a slow way to go, but I tell you, it's a really conservative and a really great way to go, in my opinion. So I just talked about this. I'm on acquisition phase. So acquisition phase meaning that you don't own any property. So I personally wouldn't necessarily worry about how fast can I pay down my loans. Okay, I want to buy my first property and pay it down as fast as I can. If you do that, that's going to take 8 or 9 years to do that, right? And then you're not in that time frame, you're not able to buy more properties and take advantage of the low interest rates and everything that are going on right now. So, do you want to do that? Again, it's up to you. It's completely up to you. But I would say if you're in acquisition phase, yeah, your plan would be to start buying properties as much as you can. 1 a year, 1 every 6 months, 1 every 2 years, whatever your plan might be. Or are you in consolidation phase? Maybe you already own a bunch of properties and you want to liquidate them and roll them into something bigger. All right, so that's something that we talk about on our call as well. Maybe you have a high price point property in California, or maybe you have your Aunt Helen's property that she heired to you, and you just sitting there and you're not earning much income at all on it, and it's free and clear. Maybe you should consolidate that, do a 1031, and roll it into something else. So let's talk about that. Let's determine what the right plan is for you. All right, step 6, determine your buy box. So speak with your RealWealth investment counselor. It's totally free, all right? So our company, we don't charge anything for these complimentary 30-minute strategy sessions. I recommend that if you haven't had one, you go on our website, and we're going to give you the place to go if you don't already know. But yeah, go to our website, sign up, and talk with one of us. It's free, and it doesn't hurt, and it's a great way to understand where you are, and we want to know what you're looking for. I mean, we're all 4 of us investment counselors. There's 4 of us, myself, Joe, Leah, and Ben. We're all experienced investors. We've been investing for many years now. We have a lot of experience, and we're all in different markets, which is great. So we all have our different opinions about different things. But definitely talk with us, because it doesn't hurt. It's a great way to get on track. And I'll ask you, I'll also mention, if you're on this call and you haven't talked with us in a long time, if it's been 2 or 3 years, yeah, definitely circle back around and talk with us. So watch the market webinar. So when you log into RealWealthNetwork.com, you have what's called the investor portal. That's your own portal. And we have all the markets right there that we have teams in currently, property teams. And on every property team, we have a market video webinar that explains the whole market and what our team is doing there, what kind of properties we're offering, all the stuff. So highly recommend you get educated that way. You can contact the property team directly. Again, the property team is the team on the ground where we offer the property, where they do the property management. You can contact them directly when you're ready, when we have an investment, when we have a strategy session. And then visit the market. I know a lot of you are not visiting markets, and that's completely understandable with COVID going on. It's getting better, hopefully, but yeah, we have some people that are visiting markets, but when you go out there, you can meet our team, you can kick the tires, so to speak. You can see that we actually have a property management company out there. You can see the rehab quality if you're buying a rehab house, or if it's a new construction, see the new construction quality. Very important if you can get out there and visit the market. Monitor listings. So when you join, when you start talking with our property teams, they will send out emails every week or two when they have a property, and that's how you're going to get alerted. We're working on right now on what's called an investor marketplace, where we're going to have the ability to have properties up on our website that you can actually browse in real time. But as of now, just join our email list for the property teams, and they send out emails, and that's how you can keep track of inventory. And then beware of analysis of paralysis. So what that means is like, don't overanalyze things. Okay, we definitely want you to be educated. We want you to talk with us if you can. We want you to look at our market webinars. We do webinars every week. We have a YouTube channel. If you just look up RealWealth Network on our YouTube channel, we have a plethora of videos on there. Kathy Fettke does her video podcast on there every week. Really, really good information there. I really can't stress enough how great. I'm a YouTube guy. I'm on there all the time, and it's a great way to get information. But don't overanalyze. Don't put the cart before the horse, so to speak, and don't worry about some of the all smaller things when it comes to investing. Just worry about what your goals are, how we can get you started, and because the earlier that you get started, the better. So, but just don't overanalyze things too much. Okay, so the last step, diligently execute. Now, Leah, the other one of the investment counselors we work with, she did a webinar recently on the investor checklist in depth. And so if you want to go back on our website or YouTube, that's posted on there so you can watch that in depth. But we have an investor checklist, and we give this to everybody that has a strategy session with us. It's also on our website. You can download it for free. And this is a list of several things that we recommend you do while before and while you're buying a property. All right. So things like order an inspection, order a home appraisal, understanding contract contingencies, consider measures of asset protection like an LLC or an umbrella insurance policy, and interview the property management company. Now, we're not your buyer's agents. We're not a legal firm. We can't give you legal advice on all this stuff, but these are just things that we recommend, and we can give you general advice, but we have all these resources on our website. We have an asset protection attorney that we work with. We have an insurance policy company that we work with. We have, property management companies that we work with. So these are all at your fingertips that you can call and do your own research on. So we just provide all that great stuff for you. And let's go to the next slide here. So this is just a recap. We're almost going to be finishing up here. So again, clarify your goals. I think we talked about that enough. Define your current situation. Discover your purchasing power. Determine your financial strategy, determine your purchasing strategy, determine your buy box, and diligently execute. So if you can do all these things, and we can go through all this on a call, if we can sit down and go over all this stuff, and you have a really good understanding of where you are and where you want to be, then the next step would be for you to start talking to the lender if you're going to finance and get you over and start looking at properties, because you would already have a good understanding of where you are and how everything works. So this is just a pre-recorded little video here that's going to navigate. So this is the investor portal. It's going to replay here a couple times, but this is where you can find all the information about the resources. You can see there's the lender section right there. On the top left, it says invest. You can click on single family, multifamily, new construction. It has all the markets that we have teams in. And in the resources tab, a lot of people don't take advantage. There's one on the very first one under resources is called investor resources. And that's where we have like the core curriculum webinar of basic investing, just a lot of great information there. So if you've not spent time on our website, I really encourage you to do so. Before you even have a strategy session, I really encourage you to sit down on our website for maybe 20 minutes and just go through, because sometimes we talk to individuals and they have no idea what we're doing or what our website's about. I really encourage you to take advantage. And all this information is free. You don't have to pay for any of it. And God bless Kathy Fettke and Rich Fettke, because all of this stuff is free on our website. And again, we just have a plethora of information to help you out here. All right, so what's next? So join RealWealth at investor.realwealth.com if you haven't already done that. Educate yourself. We do webinars every week. Like I said, we have a YouTube channel. We have plenty of webinars on our website, and speak with your investment counselor. And do we have any questions? Let me look through here if we have any questions. So I'm going to go through some questions here. And again, I really appreciate you guys bearing with me for this technical issue. I don't know what happened. So I'm actually talking on my iPhone here, doing the PowerPoint presentation on my iPhone for the first time. So I appreciate you. So yeah, I got some questions here. So let's go through some of these here. I know I don't want to take too much of your time here, but okay. So let's see here. Let's see here. Sharon asks, are closing costs a direct write-off or depreciated over time? So that's a great question. When you buy your first, or when you buy any property, even your primary home, again, I'm not a tax accountant, so don't take this for a word. But yes, you are able to use those write off those closing costs the following year on your property. So yes, you don't need to depreciate over time. I don't think you can, but it's just do it at one time here. So Michelle wanted me to explain the net worth is higher if you're leveraging net worth versus the cash. So yeah, so the example is if you have 10 properties, and let's just say for round numbers, let's just say they're $100,000 a piece. That's what the value is. If you leverage 10 of those, you now own $1 million worth of real estate. All right. If you bought 5 properties at $100,000 a piece, you have $500,000 worth of real estate. So your net worth is higher, if that makes sense to you. So when you do, and if you do decide to pay off those 10 properties at your $1 million net worth, you now have $1 million in equity, technically. So pretty phenomenal. Dave Ramsey, yes, thank you, Iris. Iris was talking, and Winston, Dave Ramsey, thank you. That's that guy. I think those guys are great. Susie Orman and Dave Ramsey, they're great for telling people not to get into consumer debt. I think they're great, but when they talk about not getting into any debt, mortgage debt is not really consumer debt in my eyes. It's a tool. So let's see here. So Iris also says here, I've been pre-approved for about $490,000 for a single family home. Is it possible to get a loan for that amount and divvy it up into 4 homes? Yeah, I mean, absolutely. Just because a dollar amount doesn't, let's just say you get pre-approved for $500,000, it doesn't mean it's only for that one house. That means that that's what you're able to get up to that loan amount generally. Again, it depends on some other factors, but keep in mind that when you get a rental property, they can also use the property income, 70% of that income, to help you qualify for your loan. So that's a plus. But yeah, you can use that for multiple properties. So Tree Nguyen asked, would it be prudent to hold now until the market settles down? There's been a ton of talk about housing market crash and even stock market crash. Great question. I don't really have time to get into whole what my theories about the market and everything, but I could tell you right now, the data shows that there is no correction coming with housing right now. There's nothing to. And the biggest thing that people have to realize is that and I think Harry Dent said this recently with Kathy's podcast. And by the way, if you don't know who Harry Dent is, look it up. It was a really good interview. But every real estate crash is coupled with debt. There's a debt issue that makes real estate prices crash like they did in 2009 or the savings and loan crisis. Okay, but guess what? There's no debt issue right now. There's no financial crisis. Okay, yes, there's a couple million homes in forbearance still right now, but those homes have equity, and so people are just going to sell their homes. But so is it prudent to hold on now? We get that question all the time. Should I hold on and buy later? Look, if the numbers make sense for you today and your money can give you a higher return today than what you're getting, then absolutely, I think it makes sense. All right. If your money's gonna lose, your money's losing value in the bank. If inflation is 3% and you're earning a 2% or earning a 1% in your bank account, guess what? You're losing money. So I think real estate investing would be a better bet. Let's see here. Let's keep going here. Oh, are you looking to open some new markets, and do you feel the current markets you're in meet the best criteria for investing in the best markets? We're always looking at markets. This is by Mark. Mark, we're always looking at new markets. We're always looking at new opportunities. We did a webinar. It's under the investor resources section under the resource tab on our website there. And Tim Horvath, he's our director of property teams. He goes through on what RealWealth does, how we screen and vet our property teams, and how we look for new markets. We did that about a year ago, and but it's still great information if you're interested in how we find our teams. Yeah, we're always looking at teams. Just know that there's a lot of great markets out there, but we don't have a team in that market. So we have to have the right team trust them. The numbers have to make sense, and all that stuff. So we're always looking at new markets. Great question though. And then you said, you also said, do you feel the markets that we currently have are meeting the best criteria for investing? I think so. I mean, right now we're in places like Texas, Florida, the Carolinas. That's where a lot of population growth has been heading. We're also in the Midwest. So I feel the markets we're in are really good. Do I wish we had more inventory? Yes, I wish we had more inventory, because some of these markets don't have as much to choose from, but you can still buy property. So let's see here. Multifamily, Tree also asked, multifamily properties were the hottest thing for some time, and that's still the case. 2 single-family homes versus a duplex. Great question. So two single-family homes versus 1 duplex. Well, if you have 2 single-family homes, you have to get 2 different loans. All right. So means you got to pay more closing costs generally, and you have to get 2 different loans. And some people don't want to do all that. A duplex would just require 1 loan. Is the cash flow going to be the same? Well, if you take 2 single-family homes and you finance them versus 1 duplex side by side, believe it or not, they're going to be about the same. A duplex cash flow, and remember, on a duplex you have to put 25% down. Anything from 2 to 4 units requires 25% down. But if you put 25% down, you're probably going to get anywhere from $600, $500, $600 a month on a duplex with financing. 2 single-family homes, again, $250, $300 a month a piece. You're going to be about the same. So the cash flow is not going to be any different on a duplex. Now, if you go to a 4-plex or a 6-unit, yeah, you're going to see a difference there. The reason why people like duplexes is because these are to scale. You can buy 2 or 3 duplexes rather than buying 2 or 4 or 6 homes. So it's really about the scaling of it. So that's really all the questions I have. If that's anyone else has any questions here. So again, I appreciate your time here, and everyone. Please call us and contact us. Yeah, thank you for watching. I really appreciate bearing with us the first 10 minutes of the technical difficulty here. But yeah, please get in touch with us, and we want to help you. Let us help you. Get in touch with us. We really want to see you succeed. And next Thursday, we're going to be having the investor panel. So if you can join us for that, we're going to be talking with members that have been with us for maybe a couple of years or so, and they're going to share their success stories. And that's going to be a really, really great thing for you guys to join if you can make that. So again, I really appreciate your time. Contact us when you're ready to talk, and we will talk to you guys later. Have a great rest of the week and enjoy the rest of your summer. I appreciate it.